far, 2023 is off to a dynamic start, both from the perspective of the global economy and global markets. Going forward into the rest of this year, there's really three themes that we're focused on. The first is a transition away from inflation being the primary focus to focusing on growth and the impact of growth. We're finally seeing evidence that central bank policy around the world is starting to really bite into growth dynamics. And we are worried about a recession, and a technical recession in particular. Now, we're not necessarily worried about the depth of a recession. We're more worried about the fact that it could last for a period of time, a slow growth world. And we're currently not pricing in some of those ramifications into market securities. The credit markets have been fairly complacent. The equity markets certainly would have a bit of downside in certain parts of the equity markets if we had a true recession in the coming year. The evidence that we've seen of the economy holding up better, while true, we think it's just delaying the inevitable. And eventually we'll see a slower growth world and potentially an outright recession in parts of the economies around the world. The second theme is really focused on the uncertainties. The uncertainties are unlikely to go anywhere anytime soon. We have ongoing uncertainties around central bank policy. Will they pause? How long will it take them to pause? Will they reverse course and go the other direction and lower interest rates? We have geopolitical concerns around the world. We have consensus earnings that look pretty high relative to the prospects of reality for those earnings in the coming year. So there's just a lot of uncertainties. And in this environment, along with that risk around growth, we do think it warrants a focus on higher quality, both within fixed income as well as in the equity market. So maintain a level of defense in your portfolios in the coming 6 to 12 months. The last theme is a bit more positive, and this is the longer term prospect for returns both in equities and fixed income. Once we get through this slower growth period and return to a growth pickup environment, we do see better return opportunities across both equities and fixed income, probably most notably in the fixed income area. Now that we've seen a sizable reset in interest rates across the globe relative to what we had just 2 years ago, the return prospects for fixed income are a lot better when you look at our 5 to 10 year forecast on most fixed income instruments relative to those same forecasts that we would have had just 2 years ago. And so, especially on a risk-adjusted basis, there's quite a bit of opportunity in our view, longer term within fixed income. And even on the equity side, while we haven't seen as much of a repricing from a valuation perspective, equities are more attractive now than they were at the peak of the market over the last 18 months. And so once we get through this muddle through environment and low growth environment, we do see better return prospects for equities as well.